Good afternoon, everyone. So, continuing with where we left in the previous session, I'll take up a question on sale and lease back. Okay, so the question is there on the screen, and using that we will understand how do we account for sale and lease back transactions. Okay, yeah, and I'll also be subsequently sharing this document in the group, which you can access, and this can be used for revision. Right now, we're looking at a sale and lease back transaction. Let's have a look at the question. Apple required funds to finance a new ambitious rebranding exercise. Its only possible way of raising finance. Its only possible way of raising finance is through the sale and lease back of its head office building for a period of 10 years. So, there is a head office building which will be sold and leased back. The lease payment of $1 million are to be made at the end of the lease period. So, you have to make the lease payments of 1 million at the end of each period. I think that is what it means. The current fair value of the building is 10 million. So, let us note down the numbers. Fair value of building is $10 million. Carrying value is $8.4 million. Interest rate implicit in the lease is 5%. Advise how to account for the sale and leaseback transaction in the financial statement if the performance obligations are satisfied and the building is sold for the following. So, what does this mean? This means that performance obligations are satisfied. When we say performance obligations are satisfied, then what does it mean? It means that it means that the sale has been successful, the sale transaction has been successful. Now, if the sale transaction has been successful, how do we account for it? When the sale value, there are two scenarios. So, first we will take up the first sale scenario. Sale value is $9 million. Fair value is $10 million. Okay. Now, coming back, yes, sale value is 9 million, fair value is 10 million. Now, one part is, it says the sale performance obligation as per IFRS 15, it has been satisfied, hence sale can be recognized. That is very clear. Now, why will I sell something worth 10 million at 9 million? See, there is a seller, there is a buyer. Seller is selling something worth 10 million at 9 million. So, if you are selling 10 million worth of something at 9 million, what does that mean? You are giving a kind of a discount. You are saying, okay, this property is worth 10 million, you pay me only 9 million. So, 1 million of benefit is there with the buyer. 1 million of benefit is there with the buyer, and the buyer is now leasing back. When you lease back, what happens is, this $1 million of benefit or $1 million, what is the benefit left with the buyer, is kind of a prepaid rent made by the seller. So, if the transaction price is lesser, than the fair value, the difference is considered to be prepayment. So, you have received, amount received 9 million. Think of it like you have received 10 million and you have given back 1 million. So, prepaid rent or prepaid lease 1 million, prepaid lease 1 million, right. Then, there is a lease back, lease back of what? Lease back of 1 million for a period of 10 years. So, we have to calculate right of use asset. Let me just open an Excel, it will become faster. Now, there is a lease back. So, one transaction is sale. Sale mein what we are saying, 10 million worth of property we have given, we have received 9 million, and that 1 million is considered to be as if we have paid the rentals in advance. Now, there is lease payment. Lease payment is $1 million. Term is 10 years. Rate of interest is 5%. So, ROU is present value of lease payment or lease liability, I would say. Lease liability is present value of lease payment, that is nothing but present value. I am not doing a detailed calculation because these numbers will be given to you in the examination. 5%, 10 years, and when I do 1 million, the present value of lease payments comes to 7721.735. So, lease liability is 7721,734. This is the lease liability. Okay, 7721,734 is the lease liability. Right. Now, carrying amount of PPE is 8.4 million. This is already given to us in the question. Now, the question is, how much gain has to be recognized? How much gain has to be recognized in the given scenario? So, now in this entire set of transaction, what we need to understand is fair value is 10 million. Right retained is nothing but your 7721,734. To that extent, we have retained the rights. So, it is 7721,734. That is the right retained, which is 77.21%. So, rights transferred is 22.79%. Right retained is 77.21%, right transferred is 22.79%. So, of the existing carrying amount multiplied by 77.21%, which is 840, 123 into 77.21%, that is 6485640. This is retained and balance is transferred. So, if I do minus 840, 123 minus 6485, 85640, 77, I think 10 extra I have put up, 1914360. This is transferred. Okay. So, 1914360 is transferred. Okay. 1914360 is transferred. 6485640 is something which is retained. So, what happens is this 6485640 what is retained, this will be your right of use asset. This will be your right of use asset which you have to continue to recognize. So, basically the idea is, see, we have sold at 9 million. There is a prepayment of 1 million, we have sold for 9 million, there is a prepayment of 1 million and value of asset sold is 840. Now, when we have sold the value, when we have sold an asset with a carrying amount of 8.4, we have also got back a right to use asset of 7721. So, to that extent, we have retained the right to use. And balance is what we have transferred. So, what we do is, when we pass the entry, we will say debit bank 9 million, this is the amount received, debit repaid 1 million, this is the portion which is prepaid, then credit lease liability lease liability is 7721,734. This is what is the lease liability which is, which we have incurred. Then credit PPE no longer existing, 840,12,123, and we have a debit ROU asset of how much of this value which is retained, 64,856,40, 64,856,40, and balancing figure is gain which will be recognized. Slightly complicated, one of the tougher part of the accounting for leases. So basically what you need to understand is the total amount that has been received, plus your ROU asset is on one side. So basically you have received this amount and you have received a right to use asset, and on the other side you have incurred a lease liability. PPE is credited because it has gone out, and the balancing figure represents a gain. Any question in this?
If you try some it will be clear.
So maybe try the question from in the material what we have, the main material, that you can try once again. Okay, so then it would be easy. Now second scenario which is given is, this is 9 million. Second scenario is 11 million. Now when you sell something for a higher amount, the extra amount that is received is 1 million is towards finance. So here when you pass the entry in bank, it is not 9 million, it is 11 million. Now here there is nothing called prepaid, because we have not prepaid, we have received extra money. That extra money of 1 million gets added to the lease liability. So lease liability will be 8721734. Lease liability will be 8721734. Remaining all will be the same. Okay. So that is how we account for sale and lease back transaction. Especially when you have leased back, the thing that you have to keep in mind is ROU asset you will recognize based on carrying amount. You see, we didn't recognize ROU asset saying 7721,734 based on the carrying amount of our asset, because it is our own asset. So it should not be that something worth 8.4 I sold at 10 and now I am recognizing a higher ROU asset. This should not be done. So that is why we base it on the carrying amount. Now we move to the next standard, which is IAS 10, events after the reporting date. A very simple standard, and the thing that you need to understand here or identify here is there are events which occur after the reporting date. So say this is the financial year, 1st of January of year 1, 31st of December of year 2, and let us say on 20th of February, no, not year 2, year 1, year 2, this is the date on which financial statements are approved. Now the whole crux of the standard lies in understanding the concept that we are on the reporting date. We are on the reporting date. On the reporting date, on this particular date, are there any conditions or circumstances? So there must be a condition or circumstance on this reporting date about which we got additional evidence or information in the period after the reporting date but before the financial statements are approved for issue. So if there is a condition on this date, for example, there is a court case going on, is the condition existing on the balance sheet date? Yes. Then did we get any additional information about the court case subsequently? For example, we lost the case. On 31st December, case is going on, it is a contingent liability. After the balance sheet date, before the financial statements were approved, we lost the case. So if you lose the case before that period, then This information provides us additional evidence about the condition existing on the balance sheet date, and this additional evidence about this becomes adjusting event. So, when I say adjusting event, then I will say because I have lost the case, this is not a contingent liability, this is now a actual liability. This is not a contingent liability, this is but a actual liability, right. Similarly, there could be a customer who is facing difficulties about which we get subsequently information that the customer has become bankrupt. So, if the customer has become bankrupt, again it is an adjusting event, right. So, if there are conditions on the balance sheet date, subsequently something happens which gives us more information about conditions existing on the balance sheet date, then we adjust the financial statements. Now, if the event is completely new, for example, there is a fire which has occurred, or there is an acquisition of a business, or there is a fall in the value of investment or inventory, all of these are non-adjusting events. These are events which are occurring purely in the post balance sheet or post reporting period. So, you need to understand what are adjusting, what are non-adjusting. Adjusting, there must be a condition on reporting date for which we receive additional evidence before financial statements are approved. Then it is an adjusting event. If we get information after the financial statements have been approved, or if we get information about an event which was not existing at all, then it is a non-adjusting event. Adjusting event means you will adjust the financial statement, non-adjusting event means you will not adjust the financial statements. Okay. So, this is IAS 10, adjusting a non-adjusting event. Quite likely that you might get a question where you have to identify whether it is an adjusting event or a non-adjusting event. So, sometimes what happens is, in the financial period there is a fraud. From 1st of January till 31st of December, there is a fraud. This fraud is detected here after the reporting period. Is this an adjusting event? Let us say fraud, there is a cash theft. Is this an adjusting event?
Yes, sir.
It's an adjusting event because fraud was existing and it was subsequently detected. But if fraud itself happened after the reporting period, then it is not called an adjusting event. Okay?
Sir?
Yes?
If a debtor becomes bankrupt after the reporting, but we don't have we did not provide any provision for that.
So, it is not about providing, making a provision. Was the condition bad? Was the condition bad? See, as on the balance sheet, if it was not bad and subsequently something happened, then it may not be an adjusting event.
Yes, sir.
Okay. Now, moving on to the next one, IAS 37, which deals with provision, contingent liabilities and contingent asset. Now, for that we need to understand what is a liability first. Liability is a present obligation arising out of past events, and there is a probable transfer of resources. Okay. So, if there is a present obligation arising out of past event and there is a probable transfer of resources, we call that it is a liability, right. Now, there is a slight difference between what is a liability and what is a provision, and then a contingent liability and then a contingent asset. When we say provision, provision is also liability. But here you have to make an estimate of outflow. So, if you are talking about a provision is a liability, But when we talk about a provision, there is an estimate. So for example, if at all you say, let us say you talk about a case of warranty. In case of a warranty, there is a present obligation which is arising out of past events, but amount is unknown, timing is unknown. So in such cases, what we say is we create an estimate. How do we create estimate? We create an estimate using probability. For example, sales is 1 million, expected warranty claim is 2%. So what you do, 1 million into 2%, which is 20,000, is your provision for warranty. Okay, so that is what is the provision for warranty. So when we say provision, it is a liability where either the amount is uncertain or the timing is uncertain. But yes, there is some obligation, we know we have to pay, but we will pay, we will consider probability and then we will calculate what is the provision to be done. Sometimes what happens is there is a single outcome or single obligation. When I say warranty, there are multiple obligations, you have sold to so many customers. When there is a single outcome or a single obligation, then you will say which is the most likely amount. For example, there is a case going on and there is a chance that we will lose $10 million or we have to pay $15 million or we have to pay $20 million. Probability is, let us say 20%, 40%, 20 is 40, 30%, and let us say for 25 million, 10%. Now, if there is a single outcome, win or lose, in this case, you will say, okay, highest possibility is for 15 million, so this is the amount of provision you will make. But if there are multiple outcomes and if there are multiple obligations present, then in that case, when you have a large population, then in that case what you do is you calculate amount into probability. This is what is called the expected value. Okay, amount into probability, expected value, that will give in case of a large population. In case of a single outcome, you will use the most likely amount to determine the provision. So that is about provision, where you have to make estimates. Okay, only two things. If there is a large population, you have to use weighted average or the expected amount method. If it is a small it's a single outcome, then you will use the most likely method, most likely outcome part. Now, another part is contingent liability. When we say something is a contingent liability, it is a possible obligation, something like a court case. In case of a court case, there is no present obligation. It is possible that in future you will have a outcome because of which you will have to pay some amount. So that is a possible obligation, it is not a present obligation. Or it is a present obligation, but there is only a possible transfer of resource or amount can't be measured. Now, the difference that you need to understand here is, here I am saying present obligation. Oh, sorry. I'll just repeat it. I am again repeating. Contingent liability. When we talk about contingent liability, there is a possible obligation. Now, possible obligation means it is not present. When I say something is a liability, there has to be a present obligation. Today there must be an obligation. But if it is a possible obligation, then it is not a liability, it is a contingent liability. Possible means in future there may be an obligation. For example, a court case going on and we do not know whether we will win or lose. If we know we will lose, then there can be a a provision for which we have to be there can be a provision that we need to create. But if we don't know, we are not sure whether we will win or lose, then in that case it is a possible obligation. Second scenario, it is a present obligation. I know there is an obligation today, but transfer of resources is possible. Possible means less than 50%, less than or equal to 50%. Here we said probable. This is greater than 50%. So when I say probable, chances of outflow are greater than 50%. When the chances of outflow are less than 50%, it is possible. So possible transfer of resource. So it is a possible transfer of resource, that is one part. Or I cannot measure the amount. I know there is a present obligation, but I do not have means to measure the amount at which I will have to transfer. So in all these scenarios, there is a contingent liability which is disclosed in the financial statement. Please remember, contingent liabilities are not recognized. Liability is recognized, provision is recognized, contingent liabilities are not recognized. They are just disclosed in the financial statements. Okay, so contingent liability, they are not recognized, they are just disclosed in the financial statement. So just a quick recap: if it is present, probable, then it is a liability or a provision. If it is possible, then it is a contingent liability. It is present and probable, but amount cannot be determined, then also it is a contingent liability. Now, few things to keep in mind. Future operating losses, for this you do not create a liability or a provision. So in future, if I operate, I will incur losses that is related to future, that you will not recognize. Then onerous contract. Onerous contract means I have entered into a contract where the net outcome of the contract is a loss. Net outcome of the contract is a loss. So I have entered into a contract. Let us say in that contract I will get inflow of 1000 and I have an outflow of 1200, and this cannot be cancelled. So we say this is a burdensome contract. So in this case, you create a provision for 200 of loss. Okay. Then if there is restructuring, restructuring means you are shutting down a particular plant, you are shutting down a particular unit, or you are moving employees from one location to another location, or you are generally laying off employees, that is called restructuring. So here you are either, there is either a sale or closure, you have withdrawn, or a general reorganizing. Now, when you carry out a restructuring activity of the organization, there could be some obligations. Let us say, because you have to cancel the contract with the vendor, you have to pay a penalty, or you are cancelling the contract with the customer, you have to pay a penalty. The moment you restructure, there are some obligations for which you need to create a liability or a provision. So you will have to recognize a provision if there is restructuring activity. Okay, so you announce to the employee, we are laying off 1000 employees, and after 6 months your services will not be needed, but because we are laying you off, we will pay 3 months salary extra. So this 3 months salary extra, for this you have to create a provision, the date on which the restructuring is announced, and after that the company cannot withdraw from the restructuring announcement. The third part is contingent asset. Now, like contingent liability, contingent asset are also possible assets which will become asset on happening or non-happening of a future uncertain event which is not within the control of the entity. So these are possible assets. In future you may have those assets. Now, if it is a possible asset, right, depending on the scenario, you will have to see if they are certain, if they are remote possible, or remote possibility means very less chance that we will get an asset, ignore. Sir, what is the example? Example could be, one company has filed case on another company. Apple has filed case on Samsung. Now, when Apple files a case on Samsung, for Samsung it is a contingent liability, for Apple it is a contingent asset. If it wins, it will get the money. Now, what is the chance of winning? Sir, very less chance. I don't think we will win the case. So, ignore. Probable. Sir, we have greater than 50% chance of winning. Disclose. Virtually certain means 90%, 95% we believe we will win the case, then you will recognize. Okay. So, these are the three categories of contingent asset. So, provisions, you have to create a liability or you have to recognize a liability. Contingent liabilities are only disclosed. Contingent assets are ignored if it is remote. If it is probable, you will disclose. If it is virtually certain, you will recognize an asset. Any questions on this? This slide? Soumya, I missed your message.
No, sir. Before restructuring, there is one more slide up there. Before restructuring.
This one?
This one?
Yeah, that one.
So, contingent liabilities, I think you need to mute, I think there's a resound coming up. Contingent liabilities are not recognized. Not recognized means they are not accounted, or for this you will not pass an entry. No entry. They are only disclosed in the financial statement. For example, a court case is going on and it's a contingent liability. We do not know whether we will win or lose, but we may lose also. If we lose, you have to, whatever is the amount you feel that has to be paid has to be disclosed. So, if it is a present obligation, outflow of resources is probable, what you will do is you will create a liability or a provision. If it is a possible thing, then you will disclose a contingent liability. If you cannot determine the amount, then also you will disclose a contingent liability. Okay. Bala, any questions? Yeah. Okay. So, we will end it here. We have covered, 2 standards. We will continue tomorrow. I have a doctor's appointment. I will let you know if we will have a class tomorrow or not. Otherwise, we will have it on Monday. Okay. And then we will continue to do it. So, next thing, next aspects that we will be covering is income taxes, IAS 12, then IFRS 15. Okay. Then after that we will go to business combination, consolidation. Okay. Please keep on practicing as much as you can, right? Sure. Thank you.
Yes. Is 12 and IFRS 15 or next class, sir?
IAS 12 and 15. Okay.